China, US deal, Trump reduces tariffs. What does it mean for India? Just imagine. A time when the world was shaken by the trade war between two economic giants, the United States and China. For months, fear loomed over global markets, investors were uncertain, and the entire world economy seemed to be holding its breath, waiting to see what would happen next. And then suddenly, from the city of Busan, South Korea, came a piece of news that stunned everyone. A deal had been struck between the US and China. In a historic meeting between Donald Trump and Xi Jinping, the two nations reached several key agreements. The US announced the removal of 10% of its tariffs on Chinese goods, reducing the total tariff rate from 57 to 47%. At first glance, this move might appear to be a diplomatic victory, but its implications run much deeper. Because this isn't just about two countries. It's an agreement that could reshape the direction of the global economy. And the most intriguing question is, what message does it hold for India? Under this deal, China agreed to purchase large quantities of soybeans, rare earth metals, and other agricultural products from the United States. In return, the US decided to lower tariffs on some of China's high-tech products. On the surface, it seems like an attempt to balance trade, but in reality, it's a strategic truce, a temporary peace deal that could easily transform into a new phase of competition in the years to come. Many economists believe this agreement reflects the pressures and compulsions on both sides. For the United States, it is a political relief, while for China, it is a matter of economic survival. Rising inflation and weakening demand in America had put pressure on the Trump administration, whereas China was struggling with slowing growth and declining exports. For both nations, this deal is like pressing the pause button, giving the global economy a moment to catch its breath. Following the announcement, global markets reacted positively. Stock markets surged, the dollar strengthened, and crude oil prices began to stabilize. But for India, the picture isn't as straightforward, because in every global deal, what brings relief to one side often becomes a new challenge for another. India, which had been indirectly benefiting from the US-China trade war over the past few years, now stands at a crucial crossroads. When tensions between the two countries were high, many American and European companies decided to move their manufacturing units out of China. Under the China Plus One strategy, nations like India, Vietnam, and Indonesia became preferred investment destinations. India gained significantly from this shift, with new factories, new jobs, and renewed momentum for the Make in India initiative. But now the situation is changing. If trade between the US and China normalize, many companies may return to China, especially in sectors like electronics, auto parts, and textiles. Several major firms that recently invested in India and Southeast Asia might reconnect their supply chains back to China. Imagine if companies like Apple were to shift their new production units back to China. What impact would that have on India's electronics exports and employment? Over the past few years, India had built an image as a strong alternative to China, and this deal could slightly weaken that position. However, it's not entirely bad news for India. There's a positive side as well. During the height of the US-China conflict, the global investment climate had become highly unstable. Now, if both powers reconcile, global confidence will return. Foreign investors, both FDI, foreign direct investment, and FPI, foreign portfolio investment, will start reinvesting in emerging markets. And for countries like India, this could be a golden opportunity, because stability is the first condition for investment. India's strong economic growth, political stability, and vast consumer market make it a natural magnet for foreign investors. As global markets stabilize, investors seeking safer, faster-growing destinations will turn toward India. This could have a positive impact on the strength of the Indian rupee, stock market stability, and overall capital inflows into the country. Now comes the key question. In which sectors can India benefit from this deal? And in which ones might it suffer losses? Let's start with agriculture. Under this agreement, China has pledged to purchase large quantities of soybeans and other agricultural products from the United States. This directly means increased pressure on India's agricultural exports. China, which earlier imported limited quantities of pulses, tea, and spices from India, will now meet most of its demand through the US as a result. Indian farmers and agri-exporters may face a setback in terms of reduced demand and global competition. On the other hand, if global inflation eases and logistical supply chains normalize, India's industrial production will gain relief. The cost of raw materials for the manufacturing sector will decrease, giving a much-needed boost to domestic production. So, while some sectors might face challenges, many industries will experience this as a breathing space. When it comes to the IT and services sector, the outlook for India appears even brighter. As global economic stability returns, companies increase their tech investments in software, data analytics, cybersecurity, health tech, and fintech. Indian giants such as Infosys, TCS, Wipro, and Tech Mahindra stand to benefit significantly, securing new contracts and expanding their global footprints. Additionally, the pharmaceutical sector could also gain indirectly from this deal. The US is now investing more heavily in health infrastructure and trying to diversify its supply chains. India, being the largest supplier of generic medicines, could further strengthen its presence in the American healthcare market. However, a major geopolitical risk still looms. While this US-China deal may appear economic on the surface, it carries a strategic undercurrent. China has agreed to supply rare earth materials critical for electronics and defense technologies to the United States. In return, the US has reduced its tariffs. Essentially, both nations are weaving a new web of mutual dependence. And that's where India must tread carefully. Because as the two superpowers get economically closer, the strategic room for middle powers like India could shrink unless it plays its cards wisely. India must remain vigilant about this web of interdependence. In the coming years, the global politics of rare earth materials is set to intensify sharply. China currently controls over 60% of the world's rare earth reserves. If it begins using these resources as a strategic weapon, India will have to strengthen its domestic alternatives. India possesses significant rare earth mining potential in states like Rajasthan, Andhra Pradesh, and Jharkhand. But this potential has remained largely untapped due to policy inertia and regulatory bottlenecks. Developing these reserves is no longer just an economic priority. It's a matter of national security and strategic independence. Another crucial aspect is India's foreign trade policy. Now that relations between the US and China are improving, India must ensure its position remains strong. Because with this deal, the US might reassess its newer trade partnerships. The opportunities India gained during the tariff war era could now start to narrow. For instance, when the US imposed heavy tariffs on steel and aluminum imports from China, Indian steel companies enjoyed a surge in exports and profits. But if those tariffs are rolled back, India's competitive edge could weaken. The same risk extends to sectors like textiles and chemicals, where India had filled the gap left by China during the trade conflict. In short, the US-China reconciliation may stabilize the global economy. But it also signals that India must reinvent its trade and industrial strategies to protect its gains and prepare for a more competitive world. On the other hand, this period of calm also presents a golden opportunity for India to strengthen its global trade relationships. By maintaining dialogue with both the US and China, India can diversify its export strategy, especially toward markets in Europe, Latin America, and Africa. It's important to understand that not every global deal is a zero-sum game, meaning one country's gain is not always another's loss. The real game is about adaptation. The nations that adjust fastest to changing global realities are the ones that move ahead. For India, the message is clear. The US-China deal might deliver a short-term shock, but it also provides a strategic opportunity to refine policies with greater intelligence and foresight. India must strengthen its value chains, boost local manufacturing, and enhance self-reliance across sectors, from agriculture to technology. The deal between Trump and Xi Jinping is just the beginning of a temporary truce. Both countries are seeking relief from internal pressures. But history shows that US-China economic friendship has never been permanent. It's a convenience partnership, one that could collapse the moment their interests diverge again. That's why India must use this interim window wisely. Because when two giants shake hands, the cracks between them create new opportunities. And India must rise through those cracks to emerge as an independent, self-reliant, and decisive economic power. In the end, the true message of this deal for India is crystal clear. The world is no longer confined to two poles of power. It is searching for a third path. If India positions itself on that third path, the coming decade won't just belong to Asia. It will be remembered as the decade.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.